morning, warriors. How's everyone doing today? Everyone doing all right?
Oh, is that a Hawaiian shirt?
No.
Oh.
Now can you tell?
America. I like it.
America in distress shirt.
America.
You told us not to be political, so I put it on a flag shirt.
America.
Leading in over one quarter of the coronavirus deaths. So, you know, America will be number one in everything. I just was thinking about America, what our country has been through. You probably people don't even remember. We went through an impeachment process, you know, and then we went through Russian elections, what Russia did in the last election, and now this, and now what the Fed has had to do, and now what the Congress has had to do, rescues, you know, and now, you know, what kind of election are we going to have if there's another wave? And, you know, I love my country, but, you know, I've been in my lifetime, this is the most worried I've been about America. So it has nothing to do with my call today, and I am attempting a short in America, in the US dollar here. Earlier in the week, talked about this possibly rallying back to 100. You know, it's also possible we could go to 101 again and, you know, shop for some stops above here. But right now, you know, my best guess is that we get some type of failing rally here. And if by tomorrow, and you never know what's going to happen, I guess we're going to have, Blake, probably the worst employment numbers since the Depression. So I don't know, maybe it's too obvious to short the dollar on what's going to be weak data, but the other reason is, it's not just that, is, let me get rid of me. All right. That I like to fade the dollar when you have a day like this, where even though the euro was under pressure, you can see on your screen you have euro down 27, you have pound down 43. So even though they're both down, the fact that euro isn't down as much are the kind of days that I would fade the dollar. Like yesterday wasn't such a good day to do it. You know, euro was down 60, 70, and the pound was actually higher for most of the day. So we'll see. A lot of it has to do with EG, and EG up around today's recovery highs went right back to this pivot point, and it's reversing here. So for EG to look good, it's got to recapture this 87.40 level. If we can do that, then, you know, you could probably declare that we're you know, bottoming, but right now it's probably still vulnerable. I have a bullish bias on it. We'll see what happens. Gold, I think I finally have it diagnosed, Blake, and I need your help. And I know you're not an Elliotician either, but take a look at the gold. And I finally, you know, this action of going nowhere for days and days and days after this high, not much of a break, you know, that we're in some type of triangle here. And I'm guessing, I bet Volgale though, that, you know, if this is wave 4 in the triangle, then what would happen would be a breakout, and the breakout's a terminal thrust. So gold's implying if we get a breakout, it could be a terminal thrust for 5, and maybe up there is a decent short. But right now it's kind of weak, and maybe for gold to get back up there and break out, a weaker dollar would, you know, give it a little bit of jet fuel. So those are my calls on that. I still, you know, I'm in the contrarian camp, and I think I brought this up once when I was on a Thursday here in when we're also being live streamed on investing.com, and this is the inverse of TLT. It's the bearish ETF on the 20-year bond, and, you know, unless, and I don't know if it's going to give it up, I guess you can't see it here, but you could see it here. We actually have a huge island. So, gap down, been a lot of gaps. So you kind of have an island bottom if this gap remains unfilled. So we'll see. So far today, looks, with risk on again today, it looks like yields are up a bit. Here's your 30-year. So 30-year has rallied 20 bips in the last couple of weeks. So, everyone talking about lower rates. I don't know. Looks like it's trying to come out of here. I know we're overbought, but I think that the most crowded trade is not long stocks anymore. In fact, before the crash, Blake, guys, last year, we had actually maybe the public was smart because the outflows from equities last year and into bond funds last year, I think, was one of the largest on record. So I'm interpreting it as the bonds are where everyone went to safety, and maybe it's not going to be so safe for a while. If we could start to turn this corner, I mean, it sure has taken a long time for it to make new lows after this panic low, and S&Ps aren't close to their lows. So if we start penetrating 140, I think 30-year yields could go back to about 2%. And the 10-year yields, I don't see why we can't get back to 150. And it doesn't seem like much, but that's a doubling of rates from where they are now. I don't know how the market will take it. Maybe that's not so bullish equities if there's some competition for rates. But I just think this is one of the more crowded trades on the board. Here's your weekly big telescopic view. And it's been a great trade for bond bulls. But this change of character right here, I think, even though the Fed came in and bailed out the bond market, we're really not making a lot of progress. So far, we failed at 78.6, and I'd say if TLT takes this out around 164, there's some pretty good open space. I'm not saying we're going to take out this, but why can't we retrace this recovery move back towards 155, maybe even 150? So still holding on to TBT. It hasn't hurt me during periods of risk off, hasn't helped me during periods of risk on. So I don't know, maybe the Fed took this market away from us too, and I probably shouldn't even be trading it because you look at this, liquidity is definitely dried up a lot in TLT. You could tell, sometimes you have to make an appointment to get a trade off. But this is my view that the surprise going into the summer could be higher yields. So Blake, good call on. I remember yesterday when Euro was doing this, you drew a line for the crowd and said, I'm not going to short it here. And you drew a line and you said you'd sell it on the pop up towards 109. And look, we had after face, we had that pop, and that's what you talked about doing. And this is what happened afterwards. That was a great call if you did it.
Thanks.
Great trade if you did it.
Thanks. I'm trying to
you remember that was like 1,000 trades ago.
Yeah. You know what? And now that I'm thinking about it, I didn't squeeze off another short up there, unfortunately. Yeah.
Well, you know what? I bet some people in the room did, Blake. Anyone take that, sell that pop that Blake talked about yesterday in Euro? Just curious.
Yeah, I mean,
we're happy to see people, do well. Okay. All right, so go ahead, buddy.
Yeah, I was really hoping for like a move just above 109 to take advantage of it. I'm pretty sure I did not short it yesterday. I try to think about every trade that I've done, and I know what I've been focusing on, which has been focusing on the Aussie yen short. That's like been my predominant focus, and making sure that the dollar yen continues lower. As you can see, this is very much a bear flag that I'm focused on. So but I mean, I did a little scalping yesterday, but I was just trying to remember if it was the euro that I was trading. Anyway, but I'm overall I'm more curious, like today, about the euro hitting the lower end of the the range. One of the, like, for example, one of the guys that I work with from the Greenwich office, we were texting, not just him, our office, we have an office text stream that we all have. We share like different news and updates and positioning and blah 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 blah. And Sunday is like, and this is when the euro was at the 109, it was 109.30, 109.40. He's like, hey, what's your view on the euro? I'm like, we're in a 108 to 110 range, so now that we're down at 108, I wouldn't want to be on the short side here. Not saying that I don't think that the euro can't continue lower. I do think it can continue lower. I just wouldn't want to be short down here after such a big run. And if you look at the euro, like, just this is the hourly chart that you see on your screen. We're dipping into oversold territory relative strength wise. We hit this previous trend line that was broke. Notice the red trend line here.
Yeah.
See how we respected that? Let me draw it out for you guys, just so you can draw that.
I like that. Okay.
You can see we respected it there.
We could get broadening formation from here, so who knows? Maybe it could go back up to the red line.
Could be, and you notice the blue trend line. We're respecting it as well. Now we got this trend line coming through here, so I wouldn't want to be short here. I do want to be short on rallies, so I do think that we could quite possibly pop back up to 109 now, and maybe give us an opportunity. But if you hadn't been short the euro this week, you probably missed like the majority of the move for now. I mean, sorry, didn't mean to yell on every morning these days. But the problem is we're probably going to see some backfilling between now and Friday. The jobs report. Now, following the jobs report, we'll see, what that does. But I'm hoping we see some little, some pop back up towards 108.60, 108.70, 109 to be on the short side of the euro. But there are things that are happening that, leads me to believe that we might not even get there. And one of them has to do with the cable. So you got the cable, it's got this, head and shoulder pattern. We just broke the neckline today. So now you got to think that, okay, well, if we get a move back above, 124, that's probably going to give us an opportunity to be on the short side. So that there's dollar strength probably coming through the cable. The Aussie remains relatively heavy here because, remember, this is a false breakout from last week. So I'm not expecting the Aussie to make much headway from current levels. I mean, we might get back up to 64.60. We're at 64.43 right now. We might be able to nudge up a little bit, but overall, I think the Aussie still is trading relatively heavy. So I guess if you're looking at those pairs, it's like, okay, well, are you really going to expect the euro, to rally much? I mean, the euro might pop a little bit, but are we really going to go too far here with the euro? So I don't know. I'm looking at the euro, and I don't want to be a buyer. It's just the same conversation we had 2 days ago when we were looking at the euro. It's like, all right, yeah, the euro might bounce, but I'm not going to be a buyer. I'd rather be a seller on rallies, and it's just trying to find a rally to trade into at this point, and that's going to be what I feel like a little bit of a struggle. It's, we're at a pretty tricky area to be establishing new dollar trades in my
numbers
view.
coming in, Blake.
Okay.
Seconds only left for
ADP.
non-farm.
Yeah.
It's late.
It's
it is
another
late.
20.23 million.
Good guess.
Well, it hasn't even popped up on Bloomberg yet.
Yeah, but it has on data flash.
Yeah. That's interesting.
You see?
Yeah. So, here's the good news, guys. If you have data flash, you guys
You got it sooner.
in ForexAnalytix, you got that before Bloomberg got it. Wow. That's interesting. Yeah, and the guys in my office are referencing it too. Like, it didn't even come up on Bloomberg, which is very interesting. Yeah, we came in really close to expectations there. So sorry, my office, I've got my speakers on a little loud. You can probably hear those guys right now. Oh man, I'll turn them down.
Not much of a reaction.
No, not a lot of reaction here. Sorry, I had to turn the speakers down. Okay, so here's the euro. Not really doing a whole lot. Stocks are bouncing. Okay, so here's another thing that I'm looking at with the S&P. So with the S&P, we had this little recovery in European trade. Not surprising. Whenever Asia's down, I expect Europe to be up, or vice versa. If Asia's up, then in European trade we're usually lower. But Europe fades Asia typically. If I had to put a number on it, I would say 75% of the time, whatever you're going to see in Asia, you're going to see the opposite in Europe. It's the way it is. I don't know if Europeans just think that Asians are a bunch of idiots and they just fade into them, but they do it all the time. I mean, it's like it's almost like clockwork. It's probably one of those, like, if I traded the European session, that would be my like dirty little secret, is always fade Asia. But anyway, what I'm going to try to point out right now, though, is that the S&P is, making higher lows, and that needs to be respected at this point, that we are, for now, making higher lows. And as long as we make higher lows in the S&P, you got to be a little careful being on the long side. A lot of people have been noting this as well. We might try to develop some sort of head and shoulder pattern in the S&P that would put a neckline that would look something like whoa, is that you, Steve?
Yep, sorry.
Jeez.
I thought it was muted.
It's like that was like one of my my
something
sneezes.
Every 5 yawns I'm going to be sneezing.
Wow. Jeez. Okay, so anyway, this is a possible head and shoulder in the S&P. Just keep an eye on it. And the reason why I point this out is because, remember, let's not forget that we're in the time of year that typically we see a little bit of selling and risk. So selling may go away. It's that time of year that tends to weigh on the markets. You just got to be a little bit more careful with being long risk, and when you start seeing signs like the S&P putting in higher low or lower highs, then you got to start being a little bit more defensive. One of the things that I'm really, and this is an overarching theme. This is not what we're seeing here in the technically anyway. One of the things that's a little concerning to me is the reopening of the United States. I mean, we are still notching higher as far as new cases of COVID-19. Death rate continues to rise, yet America is pretty hell-bent on going back to work and returning back to normal, which, I know I've said this. I get it. I totally get it. And the weather's nicer. It's for a majority of America. You and I say a majority loosely. There's a lot of people that are unaffected, and they're just like, why am I doing this? I get the attitude. I'm not saying I agree with it. I'm just saying I get it. But what I'm most fearful of is that we're going to try to reopen this economy, and it might be, premature. And I think what the market's going to be looking at moving forward is we're going to start laser focusing back on, COVID-19, the cases, and then we're going to start focusing on the fact that life is not going to go back to normal. And I think that's what is ultimately going to end up weighing on the equity markets is, wait a second, America reopened, I've got a retail store and I reopened, but wait, no, there's no one shopping. Oh, hey, I got a restaurant and I opened the restaurant, but, aside from getting some takeout, no one's coming in and eating. So I think that type of attitude is going to be is going to be the attitude we really need to watch going into the next couple of months, and I think that's probably ultimately what's going to weigh on the S&P going into the summer. So I just wanted to kind of talk that out. What do I know? I'm just making some guesses here, but I think that if you're trying to find reasons why the equities markets are, probably going to roll back over, and you guys know my longer term thoughts. I think we've had a nice bounce. I think we're going to consolidate this summer somewhere down in this neighborhood, somewhere between 2,500 and 2,700. I think that's, we overshot to the downside, we overshot to the upside. Fair value is probably somewhere in the 2,600 level, and I think that's where we're going to consolidate. And where we go from, after the summer, where we go from these levels is going to have more to do with what happens with the virus, what happens with, the economy versus, and those are data points A, I don't have, and B, I can't look into the future. I'm just, making guesses, but that's what I would think if I had to just, imagine. But that's kind of my roadmap right now that keeps me doing what I'm doing or thinking the way that I'm thinking. That's what keeps me with the idea of I'm short the Aussie yen, because I do believe that the Aussie yen, which is very correlated to the S&P, is probably going to trade back down towards the mid 60s, from 68 where we're at right now, 68, 69, back down to 67, 66. That's because of my overarching theme of the S&P, right? If you think about the dollar yen, yeah, I am bearish the dollar yen. It was my chart of the day yesterday, and we broke down here. If you guys don't know where to find that, if you go to the blog, chart of the day, dollar yen, looking at it breaking down, right? It's breaking down now. And I'm expecting the dollar yen to trade back towards 105. And it fits along with my narrative on how I feel about what's happening with equities, right? And I do feel that the yen will get a little bit of, strength. You'll gain a little strength as stocks come down. I do believe the longer term correlation between the yen and risk on, risk off, I think that is changing somewhat. But it, as you guys have heard me here over the last several months, switching off and on a correlation is not a flick of a switch. It's not, like an on and off switch for a light. It's not like, oh, the yen is not going to be used as a risk off hedge anymore. Flick the switch. No, it takes weeks and months of price action conforming to that idea. So I do think that if stocks come down, just like you saw it in the spring, in the spring, when stocks came down, the yen, when stocks came down, the yen followed suit. We snapped back rather quickly. I think if stocks come down again, the dollar yen is going to sell off, and it'll probably stabilize at a little lower levels and bounce alongside risks. So again, it's not like I'm looking at the dollar yen thinking, oh, we're going back, we're dropping below 100 this next time. No, I think the dollar yen is just consolidating longer term, and we're probably going to find some support down 105, 103, somewhere down there. That would be my initial thoughts. But again, that's where, if you look at, I brought this up earlier just so you can kind of see my focus. The active patterns in play. You can see I've got the dollar yen and the Aussie yen playing as shorts. Why? Because of my overarching thought process, plus it matches up technically, right?
Nice work.
Okay. What's that, Coach?
Nice work.
Oh, thanks. Not all trades and not everything works out, but but it's.
I bet you have
not
a very high hit rate on the chart of the day. I see so many of them manifest.
It's chart of the day. Believe it or not, it takes a little bit of thought process to actually pull up those every day.
Right.
But I try to deliver you guys at least a decent example of something that I think is setting up. So, hope you guys.
We ought to track the hit rate of those.
Yeah.
No, all
That's
right.
too much
we
work.
do enough.
That's Steve's department, right, Steve?
Yes, give me more stuff to do.
Yeah, because you need to throw
happy.
something else on your plate. Anyway, good morning, Steve. Good morning, Stelios.
Good morning.
Good
and
morning.
Coach. So I'm gonna turn it over to you guys, but before I do, I just want to mention if you guys are not, or if you've never visited Forest Park FX. Make sure you pay them a visit. They are our webinar sponsor. If you want to join the reimbursement program with ForexAnalytix, meaning that you could possibly get it for free through your trading, go to our website where it says reimbursement program. There's a couple links right here that you can actually reach out and talk directly to Forest Park FX. Because there's a lot of different brokers that you can choose from, but also if you're like, oh, I already have an account with that broker. Well, that's great because you might be able to get into the reimbursement program just by signing a document, or maybe even a cashback rebate if you're not in the U.S. or if you're not in Europe or you're only in U.S. or Canada. So make sure you reach out to them. And I'm going to turn it over to you guys.
Blake, since
Yes.
you're on the site, we have a friend here, Chris, asking where he can find the chart of the day. So since you're on the site,
Oh, right here,
why don't you show
blog.
them? Yeah.
And everyone remember, if you're going to visit and you're going into Forest Park, maintain physical distancing. So, that in every park you go to, especially Forest Park FX.
That was a swing
got
and a
it.
miss.
Yeah.
You
All right,
try.
anyway.
You try so hard every time.
I should have tried to bunt. I should have bunted.
Swing and a
All
miss.
right.
All right. You guys have
Yeah.
a great one. Thanks for
Thank you,
for
Blake.
being here with me. I'm going to turn it over to my colleagues to give you a more in-depth view of the FX market. Talk to you
Good
guys
luck
soon.
today, buddy.
Thanks, guys.
Bye-bye.
Bye.
Good
Hello,
morning,
Steves.
everybody. How are
Good
you?
morning.
Everything
What's
okay?
happening?
Good. I was actually listening to what Blake was saying, and I wanted to regarding the economy and how it's going to open up. And there's something interesting I want to say. I have two friends. I actually have more than two friends, but I have two particular friends who one of them owns a boutique hotel here in Athens Center, very nice place. And another one rents high-end sailboats in Greece and in the Mediterranean and outside as well. And they're both saying, these guys usually work with bookings 1 year in advance. They're saying nothing is being booked. So
Nothing.
my friend with the hotel actually said, look, next week we're allowed to open up from the government. We're not going to open up because the cost of operating is going to be huge compared to pretty much nobody
Income.
coming.
Yeah.
So this is just one indication. I don't think this is the exception. Obviously, things like restaurants might be a little bit quicker to get clients in, although I'm not sure
Yeah,
about those
but
either.
still, I'm afraid those are also somewhat going to work, especially in places with good weather like we have here in Greece. Now, during the summertime, those that have outside spaces, because it feels safer. But, I'm afraid that when fall comes again, it's probably going to be tough. So I'm not
Well,
very optimistic.
over there,
Yeah.
the restaurants, do they have rules as far as capacity, like 25% of normal capacity? Is all that could
Yeah,
be
they've
there?
actually set rules even for outside space. So
So
some rules are no more than 4 people at any given time in a company.
Imagine if you have 3 kids, right? You
Yeah.
can't go out.
There are minimum distance rules now between tables, which is 2 meters, if I'm not mistaken. So
how are
even
these guys going to make it on 25% of revenue? Restaurants operate on pretty thin margins. You probably know more about it than I do, Steve. But they don't have their profit margins aren't huge.
Yep,
Okay,
and
so
because it's a very competitive business. So
and
yes,
the
profit
biggest cost
margins.
is
Yeah.
the
so
biggest
how
cost
do
is rent,
any
right?
of them stay in business with 25% of the business they used to have?
I think a big chunk of them is going to stay closed, and only the ones that have been more financially prudent, let's say, and put some money aside, they're going to be operating to start with, at least. But it's difficult. It's very difficult. But this is just going back to what I've been saying for weeks now. I think the way back is going to be tough and slow. And it's a good segue to talk about the EU. The EU Commission today made some forecasts and talked about what's going to happen. And they said, look, we think GDP is going to fall in the Eurozone 7.7% in 2020, with individual countries like Italy, Spain, France around 8 or 9% lower, -8 or -9%, Germany -6.5%. But then they said in 2021 is going to be up 6.3%. Yeah, I will take the under on that one.
I will take the under as well.
Yeah, so it's I'm very worried about these projections everywhere, literally everywhere, that things are going to be back, not on track, but back to a good level next year. I really hope they're right, but
I think the projections of the rebound, Stelio, are being built on the same logic that they've been building recession assessments. So we know very well, for example, that central banks will never admit that they're seeing a recession coming until it's a proven fact that we're in a recession. I remind you that even after most countries were in lockdown, there were still some Fed members that were doubting that there's going to be a recession.
I guess it's a psychological thing as well, right?
Yeah, so it's the opposite logic, trying to persuade everybody that the rebound is going to be fast and steep, and everything is going to go back to normal in zero time, hoping that this will have some effect in people's psychology and how they perceive, because we know that perception influences a lot economic decisions, right?
Of course, and that's why governments tend to be always optimistic, because they have a big effect on the people. But on the other hand, you don't want to look like an idiot every time. When you're never getting it right on the downside, never. So anyway, I'm considering all this to be too optimistic, and I still think we will see. I've said this for quite some time. I think we'll see one more leg lower in equities before we start another multi-year rally. I don't know the speed of it, or how long it's going to be, but I think we're going to see all-time highs again within the near future. But first, there's a leg lower which is coming. That's my humble opinion. I've been wrong many times in the past, but that's what I think. And and the EU also said today, and I quote, they said, "We see extraordinarily large downside risks if this virus lasts longer, given that supply chains are disrupted, et cetera, and they talked about Brexit as well." So they're saying, look, it's going to come back really nicely, but if this thing lasts longer, then look out. And I agree with that. I agree with that. So that's what they were saying today. Data-wise, we had some PMIs today which were pretty shocking. Services PMI, Spain 7.1, so we're seeing single
digits, which is
unbelievable. Italy 10, France 11, UK 8.2, Eurozone 12. So these are scary numbers,
astonishing.
and there is a reason for this, obviously. But you know, the question is, how do we go from here? And what else? Oil is a little bit. As we're coming into expiry of the futures contract, we said we're going to see some volatility, and we're seeing it already. It's, you know,
Speaking of which, Stelio, look, I mean, if you look at the continuous, it was also, we had marked it on the chart, it was also an excellent technical point for a pullback. I mean, the confluence of the 50% fib, previous low that we had there, descending channel, trend line resistance, so triple confluence of resistances. So far, it seems to be doing the job of rejecting price action. So, you know, the risk reward would favor another move lower. And as you said, as we're headed towards the this contract's expiration, even the recent memory of what happened with the previous contract probably is enough, you know, to make investors, you know, panic. So let's see how this is going to work out.
Yep. Our friend Costas is actually saying, yes, all that's nice, but US futures are green and DAX is flat. And our other friend, the FX trader, is saying, yeah, but if everybody's saying saying we're going low, why are we going higher? Well, I think we're still going higher because everybody thought we were going to be going lower. We've been saying that sentiment and positioning has been quite bearish. If you look at sentiment, like the DSI is now very neutral, 50, 60 in S&P. I think we need that to get to the 80s or, you know, even higher.
Plus, let's not fool ourselves. This, you know, the financial markets we currently have, many of them, I mean, they do not anymore fall under the definition of what a market is. I mean, what is a market? It's a place that buyers and sellers meet, and in essence, based on you know, on the levels which they're willing to buy at or sell at, you know, there is an equilibrium. In this case, though, this is not, you know, free market shaped by choices of where value is. We have one huge buyer in the market with all its branches, because, you know, the Fed and the rest of the central banks directly, some of them, or indirectly, the rest of them, in essence, are putting a bid under the market. So the answer is basically, if we really had free markets, there would be no question where the market would be headed at the moment. Of course, as traders, you know, your main goal is to make money. It's not to, you know, to choose, let's say, the fundamentally proper side of the market and stick with it, even though that's going to cost you. But you know, to answer to that question, besides whatever, you know, what you know, everything that Stelios listed already as a reason, keep in mind that this is not a free market, right? So, you know, it is what it is, and we have to trade it. That doesn't mean that it cannot go lower. It means that, you know, the path of least resistance, as long as things look to be holding somewhat, is going to be to the upside, because central banks are creating tons and tons of inflation. And by inflation, I mean the traditional definition of inflation, which is the expansion of money supply.
Yep, exactly. And one last thing I want to mention, just as a humorous part of the day, there was a headline today which said China is considering dropping the numerical GDP growth target for 2020. So I wonder what they're going to replace it with, like some kind of a feeling, or you know, if it's not a number. I mean, I don't know, but I read that headline. I was just scratching my head.
It can be a color, Stelio.
Yeah, maybe, you know, pink. I don't know.
Or music. Right?
Yeah, I just don't get it. But anyway, I
you know something. They might as well do that, because the numbers they announce make no sense anyhow. So why have it be a number, right? I mean, the number is BS. So why even keep it as a number?
Yeah, makes sense. Sense. Yeah. So that's it. Obviously, we're waiting
Dominic says GDP rat, projection dragon.
Yeah, that's a good one.
Yeah, something like that would make sense.
Yeah. So we're all waiting for jobless claims tomorrow and non-farm payrolls on Friday. But given ADP's number today, it's going to be something near that, right? I think we're expecting 20 million losses in payrolls.
21, I think something
whatever.
like some crazy number. I mean, some unprecedented number.
Yeah. So let's see how that goes. And the main story again is how these countries like the US and Greece as well and other countries are starting to open up. And I'm a little bit afraid about how this is going to go. And Trump himself said, and I quote, "There will be more death." And he said that, if there could be a rebound in cases, but this will be like a fire that could be extinguished fast. That's what he said. So, it's a big risk, but then again, at some point you have to let the economy start again. It's a compromise between the economy and lives. I've said before, I'll always go with human lives first, but
indeed, I think the best. Yeah, but depression also costs in human lives. We know that as a fact. An economy in rubbles, in essence, has criminal activity going up by a lot. Healthcare quality dropping significantly. People not having money to, in essence, take care of themselves, etc., etc. So we know that an economic depression also has a human toll. It's not going to be that easy to categorize as it is like somebody died. Okay, did they have COVID? Yes, checkbox. Okay, so it's a COVID death. But that takes a toll as well, a human life toll. So I think the best would probably be some type of a combination of making sure you isolate people that belong in groups that are quite vulnerable, like older people or people with underlying disease, and the rest of the people, of course, using precautions, restarting the economy. I think something like that would probably be the best way forward. But anyhow, it's not us taking the decision, so it doesn't really matter.
Yeah.
Okay, Stel. So let's jump on the charts. We do have quite a few things that look interesting out there in the markets. Now, clearly, the move lower in risk assets has stalled for now. Having said that, I do think that there is a very decent chance that we're going to see more downside, very shortly. So I'm still sticking to my short positions. I'm still in the money, so I'm feeling quite comfortable about it. And I do think that we're going to see lower levels. I would expect 2630 to be tested again, 2630 to 2640.
Yeah, you have a moving average here. And Steve, the rally yesterday and today at the highs retraced 61.8 of last week's decline.
Yeah, which is golden fib in essence.
Yeah.
So we know very well that, the dollar, here it is, the dollar index, will follow whatever risk assets do. If risk moves lower, we're going to see dollar moving higher, and vice versa. So since I still believe that we're going to see risk assets move lower from here, I do believe that the path of least resistance for the dollar is probably higher. Having said that, somebody needs to obviously recognize here that the dollar is consolidating in a range. The exact same thing is happening with the Euro USD. You can see it here. I mean, Euro USD has been trapped in this 1.075 to 1.10 area. More or less the same situation here with the cable. Having said that, the cable, Blake already showed that. You can even clearly see it on the daily chart. It does seem to have posted a likely head and shoulders pattern. Of course, for this to prove to be a head and shoulders formation, we need to break through the neckline, because somebody can say, okay, this can also be interpreted as a triangle, in which case you can also break the upside and continue higher, which is, yes, it is the case. So we're going to find out which of the two is happening, depending on if we break above this potential double top or below this trend line. Having said that,
I wrote a poem about 61.8. It's very short.
Go ahead.
Okay, 61.8. Could you feel it resonate? As soon as you know the tricks, it stretches to 78.6.
That's a good one, actually.
You like it?
You know something? We're going to build a page in the ForexAnalytix website that's going to be dedicated to your poems, your singing,
good.
and your
Oh,
quotes.
okay,
What do you think about
good.
that?
Yeah. Okay. All right.
Okay.
I'll keep, making up things, just like
Yep.
my trades. All right, man.
Ben says Dale Shakespeare. Love it, says Stefan. Keep them coming.
All right.
Okay, so yeah, cable, we're getting closer and closer to the moment of truth. So, which is the direction we're breaking through. If you remember, and I know you do remember because you have an excellent memory, Mark Chandler, during the event, spoke about his belief that the cable would actually break down from here imminently.
Yeah.
So let's see if Mark is going to be on this one on the right side of the market as well. Mentioning the Traders Summit, for those of you that didn't receive the email for some reason or whatever, the recordings of the Traders Summit are on the initial page you subscribed. Now, so as you see, the page will have changed to, in essence, the post-event version of the page, and all the recordings are posted here. So, whatever you missed,
Nice.
or whatever you want to watch again, that's where you can find it. Okay. Could you please evaluate Nifty 50? Yeah, absolutely. I'm going to have a look at it. Give me a few seconds. I want to go through some other stuff first. One of them being, I'm not going to go over again the Aussie and the Kiwi because we've already shown, and the Aussie yen and the Kiwi yen, because we've already shown yesterday and the day before yesterday that all of them are either breaking down or at the precipice of breaking down. So the only thing they need is a gentle push from risk assets, and then you should see them accelerate the downside. Now, in combination with crude getting rejected from here, there is another pair we should talk about, and we briefly did. Blake briefly did. It's the USD CAD. So USD CAD looks to me like it was bull flagging, and it looks to me like it wants to break through the flag. At the same time, through this wedges trendline resistance and move higher once again. Keep in mind that 142.60 is going to be the next area of resistance, and above 142.60 we then also trigger, besides breaking through this triangle, we will then be triggering this rectangle, which has a projected target to match the previous high at 146.70. So in any case, I do think that USD CAD still remains one of the best looking USD pairs out there. So I think that if we see USD moving higher from here, as I'm expecting that it's the main case scenario, USD CAD should be doing probably better than most of the pairs. And I think we're going to be revisiting that 146.70 once again. We had two people asking for it, so it was a good way to cover that as well. Now, natural gas, question about the natural gas. We said yesterday that natural gas was breaking out from the $2 area, found resistance, as you said, the 200 daily moving average, still above $2. So I wouldn't be surprised if we backtested this area and continued higher. It's also going to depend on what crude does from here. As I showed before, key area that we got rejected from for the time being. So in the short term we might see more weakness. Having said that, I strongly believe that later during the year we're going to have much higher crude oil prices. So do what you wish with it. Now, gold and silver, we have questions about them. Nothing changed from what we were saying yesterday, the day before yesterday, last week. Gold and silver, both of them consolidating in a triangle. In both cases, that would imply at least one more leg to the upside
Could
before
this
moving.
triangle in gold, Steve, be a 4 and one more thrust be a 5 on the daily? Yeah.
Since you're asking,
Going to Grega.
since you're asking for Elliott waves,
Yeah.
let's give you a freebie here. So this is one interpretation
Yeah. So
from
that's
Grega, ABC, or alternatively a triangle for a wave 4.
okay.
And
So it could be.
and keep in mind, Dale and everybody else, that triangles, if you want to go a little bit on Elliott wave theory, triangles can only be either wave 4s or Bs in ABCs. Okay. So yeah, that would make sense.
All right. Thank you.
My pleasure.
See, I'm an amateur Elliotician.
Yeah, but
You know where I've learned it from you and Grega.
Yeah, no question about it.
My subscription was
excellent.
definitely worth it 10 times over. Really. And being here at phase.
Actually, an indefinite number, infinite, mathematically speaking, infinite number, since your subscription is 0.
What an ROI.
Yeah, an infinite return on investment, right?
Yeah.
That's the type of investments you want to be taking every single day, if possible.
That's what brokers do. They take no risk.
More or less.
Yeah.
So there is a question about the DAX, and we can move to the Nifty. Okay, actually, let's go to the 4-hour chart if you want to see it. So the DAX failed after one last thrust higher from the rectangle. That was to be expected. So far, the rebound after this move, let's delete all that because that has already happened. So far, this move looks very corrective. There we go. So that's what I would expect from here, okay? Let me go. 2 more questions, blah, blah, blah. Aussie yen seems like it's breaking down. Yeah, we've already shown Aussie yen multiple times during the past few days. Definitely looking bearish. Here it is on the 4-hour chart, right? So yeah, I also think that it's likely to break down from here. As I said, all these pairs need a gentle push from risk assets, and they should be on their way decently lower at the very least. Thoughts on ZN, the 10-year Treasury? Costa, we've shown this. Nothing is really happening. I mean, if you want to have a look at the yields or the bonds, it's the same thing. Let's go to the daily. I think that these markets have really more or less shut down. I mean, you can see it here. It looks like it wants to break lower from here, but in all actuality, I mean, volatility has died down. I think that a lot of people have given up trading these markets because they're almost fully owned, or anyhow almost fully controlled by the Fed. So I think a lot of people are giving up with trying to do something about them. Having said that, I still don't see anything really bearish with them. I mean, can they move lower from here? Yeah, they can, but do I see something that jumps out as a bearish formation? No, at least not yet. So I would be very, very skeptical. I still think we can see higher levels in treasuries, which means lower yields in treasuries before we can see some type of a large rebound in yields. I don't think we're there yet. USD yen, great insights, took a short still in. Okay, personally, I wouldn't be trading it. Yes, the path of least resistance, if you're looking at short-term charts, seems to be lower, but in all actuality, USD yen has died down. And I think there are many better places to invest your money there is a question about the GDX, and we talked about it. The GDX has broken out from a rounded bottom and from a key area of support turned resistance. And guess what? We backtested this as support again, and we're at multi-year highs. So there is no other way to say it. The GDX is very bullish against 31. Okay, as simple as that. USD MXN. USD MXN. There it is. USD MXN. Triangle. What would that imply? Likely one more thrust to the upside before lower. Now, it can end up breaking to the downside, but you know, triangles in the vast majority of the cases are continuation patterns. So that's my main case scenario here. And that would also tie up very nicely with the idea that we're going to see at least one more move lower in indices from here. I don't necessarily mean a move to lower lows, right? But I mean, you know, one move lower, we might not exceed the previous lows, for example, 2170 or whatever it was in the S&P, in which case I would expect the USD MXN to break to, who knows, 26 to 27, to, you know, between that area. And then we might see, you know, a big pullback for this pair and, you know, other risk correlated FX currencies. Notice your friends in the tier Y. Yeah, I mean, we said that. Turkish lira at all-time highs, right? You can see it here. The previous all-time high was at 7083. So yeah, Turkish lira at all-time lows. I mean, against USD Turkish lira at all-time highs. So the Turkish lira at all-time lows against the dollar. And I'm assuming not only against the dollar. We had a question about the Nifty, so let's have a look at that as well. And you can clearly see that the Nifty is not looking healthy. I mean, you know, I talked about the fact that the recovery looked corrective, and I wouldn't be surprised if we see an acceleration lower from here. We falsely broke through this wedge. We created an island reversal, gap up, bullish price action, gap down, moving lower from there, abandoned baby, or whatever it's called, if I remember right, that's the term. So, you know, big risks for a downside move from here in the Nifty. Greetings from Mexico. Hello, Phil. Greetings from Greece. OZCAD, we've already covered the S&P more or less. I mean, here it is, broken through this ascending wedge, back testing some nice area of resistance. I think there is a big danger that we're going to accelerate lower from there. Question about the euro yen, the OZCAD. We have 3 more questions. I'm going to cover them fast because I have a meeting exactly at the top of the hour. So, euro yen finally broken through the 116 area, currently testing this channel trend line support. Definitely looks heavy. Definitely, as we've mentioned multiple times, in a downtrend since February 2018. So, you know, needless to say, the path of least resistance remains to the downside. If you're looking for more downside targets, the easier way to do that would be to fib extend this. And there you go. 127% extension at 114, 161.8% extension at 111.50. As long as we break through this trend line that we're currently testing, because we're still seeing some RSI divergence. So, you know, RSI divergence with that trend line support, I would be a little bit careful here. Καλό απόγευμα, Κώστα. Aussie CAD, and I think we can wrap it up with that. Here it is. So we said that, you know, as you see several days ago, that was a strong area of resistance, roughly at 91.50. We got initially rejected from there, trying to hold this ascending channels trend line support. I think the risk reward has shifted definitely in favor of at least a pullback lower. So, you know, that's what I think about it. Okay. I mean, it can continue higher, but I think this is not the place to be buying it. You know, if you at least got an opportunity to buy it at, I don't know, 80, 88, 8 to 88.50 would probably be much better in owning it there than trying to buy it here. I think it's already a mature rebound. So, you know, I don't think it's the best opportunity. Fast outlook, USD INR, and I'm going to wrap it up with that because, as I said, I have to jump on a meeting, which is quite important actually. And Coach, do you have an interview?
Yes, Jared Gillian is with us.
Okay, let's see how many times I have to type this. Yeah, finally. Okay, use the INR. Here it is. You know, that's why corrective moves are a little bit of a pain because you need to keep redrawing until you get more price action. I wouldn't be surprised if we see another high in USD INR before lower. Okay.
A lot of these currencies you covered looks like, you know,
Yeah.
peso. All of these have,
Exactly.
you know, maybe one more push.
Yeah, exactly. Exactly,
Okay.
that's the case.
All right.
Okay, everybody, enjoy the interview.
Thank you,
Coach, write to me on Skype if you have any problems because I really have to jump on that meeting.
Go ahead.
Okay.
Okay.
Bye-bye.
All right. Jared, welcome to FACE. Thank you so much for joining us today. How are you?
Thank you.
So, Jared, have you ever used Zoom before, buddy?
Yeah, do you need me to start the video?
Or the video, or share your screen about to show what you're going to talk about? And while you're doing that, I did go to your website. It's a little green button that says share screen on a drop-down menu. See it? It'll
Yeah,
be above.
I'm trying to start the video. It says the host has stopped the video. There's really nothing interesting on my screen right now.
Okay, then I'll share my screen. Okay, I thought maybe it might have some markets you wanted to talk about, but why don't I do this? I'll share my screen and I'll go to different pairs here. Okay, so I went to your website, Jared, and I read a bit about it, you know, the questions, you know, what you do, and a bit about your history. And seems to me like the golden age, one of the golden ages for you was your time at Lehman. But I'm interested in what you're doing right before you got into the industry, and what was your first gig in the investment biz?
Yeah, so you know, I came into the industry in 1999. Before I started working in finance, I was actually in the Coast Guard.
Oh,
and I was a lieutenant in the Coast Guard. I went to the Coast Guard Academy. I did a couple of years on a ship out of Washington State, and then I worked in intelligence for a few years. And while I was getting my MBA part-time, I got a part-time job on the P Coast Options Exchange, and
okay.
that was really my first job in the business.
Yeah, what a great place to start. You know, I did it on the CME floor in Chicago, so that was up in San Francisco, wasn't it?
Yeah, and you know, it was an amazing time to be there. I mean, if you think about San Francisco, 1999, the dot-com bubble.
Oh yeah,
what a crazy time to start your career. You know,
yeah.
I mean, it was. I learned a lot, but like, you know, I like to tell people the NASDAQ crossed 3,000 when I started, and I left the floor a year later, and the NASDAQ crossed 3,000 on the way down.
Okay, you know, they couldn't do it without you. on the floor, Jared. So, and then you know, your time at Lehman Brothers, I read that you were surrounded by so many talented people. And, you know, I'm a big believer in mentorship and community intelligence gathering. So I'm just guessing that you were, you know, some people took you under their wing and you learned a lot from different people at Lehman.
Yeah, I mean, I really learned a lot from the environment. You know, I was talking about this the other day. You know, when I was in business school, you know, I was top of my class. I had a 4.0 and I studied really hard, and I did a lot of studying outside the curriculum, spent a lot of time in the library. And, you know, even after you do that, there's still a lot of things that you don't know, and you get exposed to a lot of different things being on a trading floor. You know, one of the things about working in index arbitrage is that it's really a money market trade, and you're really trading short-term interest rates. And this is stuff that I didn't learn a lot about in school. So I had to learn how to trade Eurodollar futures, Eurodollar options, Fed funds futures, and this was all new to me. So, you know, I was really self-taught in a lot of things. And, you know, I had an interest in a lot of things outside of equities. I was super interested in the bond market. I taught myself about the bond market. I became pretty much, you know, one of the only experts on the floor on bonds, taught myself about commodities. And this was, you know, this was kind of early on. This was before people were doing cross asset stuff. You know, people used to focus on one particular silo. They used to focus on one particular thing. And I was one of the few people that was really doing cross asset stuff.
Okay, so I'm assuming that you're still, do you still trade, or what do you do?
So I published my newsletter, which is the Daily Dirt Nap.
And here it is. I'm going to make a nice commercial for you.
Okay, thanks.
There you go. Yeah, and you give a facetious definition of daily dirt nap. I mean, I have a nap schedule. I get up at 4 a.m. here in San Diego. So how would I go about taking daily dirt nap instead of just, you know, snoring for an hour or so at 8 in the morning?
Well, you know, a dirt nap was a phrase that I picked up on the trading floor out in San Francisco, and a lot of the market makers, you know, they were surfers. They would get off of work at 1 o'clock.
Oh, okay.
And
it's
they
a
would
surfing term.
And they had their own lexicon, and they would say, you know, they'd look up at the screen and they'd say, "Dude, the spoos are taking a hella dirt nap," and dirt nap meant that the market was going down.
Okay.
So I kind of took that and brought it to New York, and now it's, you know, it's gone everywhere since then. So.
Okay, and is that you the day Lehman closed? That little character that looks like Wile E. Coyote coming off the cliff? So,
yeah, pretty much.
Were you there for the closing?
Yeah, I was there
Lehman?
for the bankruptcy. You know, the bankruptcy happened over the weekend. It happened Sunday night, and when they announced that Lehman was not going to be rescued by the Fed. And you know, I walked up to the building the next morning, and there must have been like 20 or 30 TV trucks there. And I'm trying to walk up to the building, and people are putting microphones in my face. And I go up there, and everybody went to work. They just they didn't know what else to do, and people kept going to work even after the bankruptcy, which was the crazy thing. They just kept going to work and going there in the hopes that you know, the firm might be rescued. And what ended up happening was Barclays bought the broker-dealer operation out from the holding company. So, you know, a lot of Lehman actually did survive under Barclays after the bankruptcy.
Okay, interesting. It looks like you've written a couple of books here, Jared. You know, I mean, this word evil sure comes up a lot in our society and on media. In fact, China used the word yesterday after, you know, Mike Pompeo said there's plenty of evidence to point towards the COVID-19 coming out of Wuhan. Tell us a little bit about your book, the narrative in here, and is it fiction or what?
Yeah, all the evil of this world. It's a novel. It's fiction.
Okay.
And it goes back to the year 2000 at the top of the dot-com bubble, and it's about the 3Com Palm spinoff, which happened 8 days before the actual top of the market. And there's 7 chapters. There's 7 characters. Each character has a part in the trade. There's a clerk on the trading floor. There's a market maker. There's a broker. There's a position trader at a bank. There's a sales trader.
Cool.
There's an execution trader at a hedge fund, and there's a portfolio manager. And each of them has a part in the trade. And each chapter is written in a different voice of each of the characters in the first person.
Okay. And this book, Street Freak, is sounds like a little bit more of a biographical take on what you went through during this time frame in the world.
Yep, that's right.
During the, they call it the Great Recession. Was it great for you, Jared?
Well, the interesting thing is that, I had a lot of Lehman stock. I lost the stock. I lost money. I got hit pretty hard. But I can tell you that a recession is a great time to start a business. It's really the ideal time to start a business. If you can start a business in a recession and you can survive, you will do very, very well in the up part of the cycle. So.
Okay. What's your definition of what we're in? And I'll take into account neither one of us have ever were around for the last pandemic. And, what's your view with, let's say the rescue effort made by the Fed and by Congress? And do you think it's going to work? The Fed, do you think the Fed is going to be as effective for as long as they were after we finally put in lows in 2009 to continue to reflate asset prices?
Yeah, I think the reaction function of the Fed has changed over the years. We as a society, we're not willing to tolerate losses in the stock market. Like in this country in the last 10 years, basically, the Fed and the government explicitly support stocks. And what we have right now is a very big disconnect between what's going on in the economy and what's going on in the stock market. Now, there's this quote that says that the stock market is not the economy, and that's always more or less true all the time. But it's more true now more than ever. I disagree with a lot of the actions that were taken. But my personal feelings about it really don't matter. As somebody who manages money, you have to put your personal feelings aside and you have to invest, as things are, not as they should be. So, I've traded alongside the Fed in this rescue. I've gotten involved in a lot of credits, a lot of investment grade, high yield, preferred stocks, stuff like that, because the stuff that the Fed is explicitly supporting.
Okay. Well, you mentioned earlier that you're one of the first to really get a handle on bonds on the Pacific Exchange. I think that, once a bond trader, always a bond trader. Interest rates are an excellent market, clean technical market, and really, besides currency, kind of the fulcrum of what everything revolves around. So have you ever seen anything like this? We had this blow off in the bond market. And then before the Fed came in while we were crashing, I've never seen such a dramatic 1 week move in bonds in my career. And I guess I'm even older than you. And so the Fed came in and they bought the corporates, right? They bought LQD, and they came in and they bought junk. So here's the recovery in corporates. It was even more dramatic than treasuries. And I guess the laggard right now is, the junk. So looking at this high yield debt, what's your view on the bond market now? Have these markets been nationalized and they're no longer free markets? The treasuries with what the Fed did, I don't even think it was, I think they had to get special permission to come in and buy corporates. So having watched bonds for as long as you have, what's your view on direction, and have central planners taken the market away from us?
Yeah, I mean, that's definitely true, although there's still things you can do. In treasuries, the yield curve has steepened a lot just in the last few days.
Yeah.
Because the Treasury is planning a lot of issuance to pay for all the stimulus, and we're going to be doing trillions of issuance this year. I just skimmed an article about the quarterly refunding. So what's happening now is that the back end of the curve is starting to sell off because of all this issuance.
There's the back end on my screen. So
yeah, we're also going to be issuing a 20-year bond, which isn't new. We had those in the past, but they're coming back. So they want to issue more in the long end of the curve and take advantage of issuance. When it comes to high yield, the high yield market is kind of bifurcated. All bonds, the market split in half. You have the bonds that they're buying have 4% yields. The bonds that they're not buying have 10% yields. And there's pretty good opportunities in the space where they're not buying the bonds. I mean, anytime you get out to double-digit interest rates, it starts to get me interested. So,
okay, well, you have any forecasts here? I'm actually, I've been talking for a while, especially after this recovery, and there was a lot of cash moving out of equities last year, really before the top came in, and everyone moving into bonds. I think it's the most crowded trade on the planet. And do you think there's possibility that this was just the first wave down in yields, and that this could be a failing rally, and we could start seeing yields head up quite dramatically? Maybe we get the 10-year back to having a decent day today, about 1.5% to 2%, and the 30-year back to 2%.
well, if borrowing costs start to go up significantly, I mean, right now the Fed is doing unlimited quantitative easing. There's no cap on the quantitative easing.
Yeah, you'd be fighting the Fed with that position, wouldn't you?
Well, kind of. I mean, right now they're only doing about $8 billion a day. They were doing $10 billion before, $12 billion. So they've reduced the QE by a little bit. But if our borrowing costs start going higher, then if 10s get out to 1.5% or 2%, my guess is that the Trump administration is going to ask the Fed to directly monetize the debt to keep interest rates low. So I think there's a possible that yields go higher in the short term, but ultimately, I wouldn't be betting on a bond.
Well, who knows who's going to be asking them to do that towards the end of the year?
Yeah.
You're assuming a re-election. So who knows what's going to happen. It is a position where you're fighting the Fed. I think there's opportunities on the short side of bonds, because what do you think that it's a health crisis that has turned into a financial crisis, which has turned into a credit crisis. So you've seen credit crises before, and we could have a bear market in bonds under those conditions. Especially, I also notice you're a follower of currencies. I'd be curious if you have a view on the dollar. I mean, it's pretty divided camp. You have a lot of dollar bears that are saying, we are putting in a major top, and, someone I respect is, talking about a 50% clip of the dollar in the next several years down to here. What's your view? Are we peaking here in the dollars? This is a monthly chart. Or a lot of people talk about the shortage of dollars and the pipes that are needed for emerging markets and all their debt, and that there's a dollar shortage. Which side of the fence you come down on?
I kind of don't come down on either side of the fence. I mean, back in 2014.
You're strongly neutral to the dollar?
Yeah, kind of, for now.
Okay.
Like,
Right. That's fair.
I really got the long dollar trade right about 5 or 6 years ago. I was short the Canadian dollar. I was short the New Zealand dollar. I was short the Australian dollar, and that worked really well. I'm still short the Canadian dollar, mostly for idiosyncratic reasons pertaining to Canada, but I don't really have a strong view on the overall direction of the dollar here.
Okay. Anything you do have some conviction on? Like you said, you're a money manager. You're managing money.
No, I'm not managing outside money. I'm managing my own money.
Okay.
But
so
outside money.
If one of your subscribers came to you, Jared, and said, I have 100K, Jared, cash, how do I deploy it? What would you tell them?
I'd tell them that I can't give personal financial advice.
Okay.
I publish the newsletter. I can disseminate ideas and recommendations to, all my subscribers, but I can't answer emails like that.
All right. Well, how about us? I'm not asking you for. I'm not going to plagiarize your ideas. All right. Let's just say you're flat right now. You own nothing. What would you be doing in the markets here? Besides talking in generalities.
Yeah, over a 10-year period, I came up with something, and I didn't have a name for it, so I just called it the awesome portfolio, which is kind of a joke. But I think that you need to have exposure to inflation over the next 10 years. And I think that ordinarily you would have a lot of bonds for diversification, but I think the diversification benefits of bonds have mostly disappeared at this point. So my allocation would be 20% equities, 20% bonds, 20% cash, 20% gold, and 20% real estate. And it's the gold and real estate piece that sort of gives you some diversification and gives you some exposure to inflation if we end up getting that.
Okay. Do you feel that what the Fed has done is going to for sure lead to it? Because there are still some guys that are in the deflation camp. Do you think there's a possibility that the Fed is pushing on a string? I mean, before the coronavirus, we were already in a manufacturing recession. People forget that. They think that everything just happened. There were problems in the repo market in the fall. So there were things going on that weren't so positive in the economy, and the consumer was the only thing holding up the economy. So do you think that the consumer, even when they loosen up, is going to go out and return to their normal patterns, or are we all going to have PTSD here?
I think kind of the latter. I think we're going to have PTSD, but I wouldn't call it PTSD. I think I've talked to a lot of people, and one of the things that people are starting to realize during the lockdown is that their consumption patterns have changed, and they're spending a lot less and they're saving money, especially if they have incomes coming in. So, I don't think that we're going to return to previous levels of consumption for many, many years. And if you think that consumption is 70% of GDP, then this is we're going to have very low GDP, zero, possibly negative for a long time. I mean, I think we'll have negative GDP for out to 18 months.
Okay. And even though you would still go with 20% equity in that environment, is there a sector of the market that you think will come back quicker? I mean, on this reflex rally we had in the S&P, by the way, gold's crunching. I thought we'd get one more high, but it doesn't look that way. But on the S&Ps, we had this rally from late March, really led by what got us here, Microsoft, Amazon, anything you see sector-wise in the market. Assuming you like gold, do you like the miners too? They've been very strong as of late.
Yeah, I like gold a lot. I like the miners. I also think that, I study sentiment, and I think the sentiment significance of front-month oil futures trading down to negative $30 is pretty, I think that's pretty significant. And I think that was the sentiment bottom in oil. So I'm actually reasonably bullish on energy here, and energy has rebounded quite a bit. You could have bought ExxonMobil at a 10% dividend yield. Now it's at a 7.5% dividend yield. There were some pretty big opportunities. So I think energy is actually going to do okay.
Okay. All right. And the best way for people to follow you, Jason?
You can follow me on Twitter at Daily Dirtnap. You can follow me on Twitter at Daily Dirtnap, or you can go to my website, which is dailydirtnap.com if you want to subscribe.
And you're a DJ?
Yeah, I am. Yeah.
All right. Well, I believe that music feeds our soul as well, Jared. So, it's nice meeting you, and you have your own radio show as well, right?
Yep. It's called The Jared Dillian Show. It's on 6 to 8 p.m. Eastern Time, Monday through Friday.
Internet station or like an internet type broadcast?
It's on a handful of terrestrial stations. You can also stream it at jareddillianmoney.com. Okay.
All right. Well, I wish you and your loved ones remain untouched by this virus, and thank you for taking out the time of your schedule to come and talk to us about what you do.
Thanks a lot, Dale.
And there's a price you pay for coming on. Do you know what it is?
No, what's that?
You're now my trading warrior brother. You accept?
Yeah, I accept.
All right, bro. So that's a wrap, everyone. That's Jared Dillian, and you know where to find him now on Twitter. Or if you're interested in his subscription, go ahead. That's a wrap for us. Everyone, good hunting the rest of the day. And remember, most of all, even though America is in a little bit of distress, don't forget, don't just count your pips, count your blessings. We'll see everyone tomorrow. Wrap up the week with NFP. Adios.